Introduction. Why starting small is the best start. Listen up. It's time to face the facts. If you've been sitting around waiting for some magic windfall to fix your finances, you're fooling yourself. Nobody's coming to rescue you. The lottery isn't your savior, and that promotion you're banking on isn't guaranteed. You've got one reliable resource in your life, you. And that's exactly where this starts. With the $10 you claim you don't have, but somehow manage to spend on coffee, junk food, or some other nonsense every week. If you're rolling your eyes right now thinking $10 a month won't do squat, let me tell you, you're wrong. Dead wrong. That tiny sum is the seed of something powerful, if you have the guts to plant it and the discipline to nurture it. But let's be clear, this isn't a book for people looking for shortcuts or excuses. If you're too busy whining about how hard it is, close the book now and go back to wasting your money. This is for people who are ready to stop talking and start doing. Here's the deal. Investing isn't some elite club reserved for the rich. It's a tool, and it's available to anyone. But like any tool, it only works if you pick it up and use it. And that's what I'm here to teach you. I don't care if you've never invested a single dime or if you think you're bad with money. That stops today. If you follow what's in this book, you'll not only learn how to invest, you'll learn how to own your financial future. Still with me? Good. Here's what's coming. You're going to learn how to take the $10 you blow every month and put it to work. You'll understand how money grows over time, how to manage risk, and how to build something real for yourself. No gimmicks, no fluff, and no hand-holding. This isn't about getting rich overnight. It's about doing the hard, unglamorous work of building wealth over time. You're going to get uncomfortable. I'm not here to make you feel good about wasting years avoiding the one thing that could change your life. But if you stick with me, you'll look back one day and thank yourself for finally getting off your backside and making a change. Because the truth is this, the difference between people who build wealth and those who stay broke isn't income, it's mindset and discipline. And discipline starts with small, consistent action. In this case, $10 a month. No excuses, no pity parties, just results. Let's get started. Chapter 1. Changing your money mindset. Let's start with the cold, hard truth. If you've been telling yourself you're bad with money, you've been lying. That lie has been your excuse to avoid responsibility. And here's the thing about excuses. They don't pay the bills, they don't grow wealth, and they don't fix the mess you're in. So if you're serious about turning your finances around, it's time to face reality. You're not bad with money, you've just been lazy with it. Lazy thinking is the root of financial failure. You know what I'm talking about. The belief that money is too complicated to figure out, or that it's only for people who already have it. That's the kind of mental junk that keeps people broke for life. And I'm here to tell you that it ends today. No more whining about what you weren't taught in school. No more blaming the system, your job, or the economy. Starting now, the only person responsible for your financial future is you. If that sounds harsh, good. It's supposed to. Because the biggest obstacle to your success isn't your income, your circumstances, or even your past, it's you. You've been your own worst enemy, making excuses instead of making progress. And guess what? You're not special. Everyone has their reasons for why they haven't gotten started. The difference is, some people push past those reasons and do the work. Others stay stuck, waiting for some magical solution that never comes. Let me break this down for you. Money doesn't care about your feelings. It doesn't care that you didn't have the right role models growing up. It doesn't care that you're struggling to make ends meet. Money is a tool. It does what you tell it to do. If you waste it, it disappears. If you use it wisely, it grows. It's that simple. The problem is, too many people refuse to take control of their money. They let it slip through their fingers on stuff they don't need, then complain that they don't have enough to invest. Here's where I stop being polite. If you can find $10 to blow on coffee, fast food, or junk you'll forget about by next week, you can find $10 to invest. And if you're telling yourself otherwise, you're lying to yourself. You're telling yourself that your comfort today is more important than your security tomorrow. You're choosing to stay broke because it's easier than doing the hard work of building wealth. And that's unacceptable. Investing isn't about being rich, it's about building discipline. It's about proving to yourself that you can take control of your financial future, no matter where you're starting from. The $10 you invest today isn't going to make you rich overnight. But it's going to do something even more important. It's going to teach you that small steps add up. It's going to show you that your excuses are nothing but noise, and that the only thing standing between you and financial freedom is your willingness to take action. Now, let's talk about mindset. Your current mindset around money is the reason you're stuck. Maybe you think investing is too risky. Maybe you believe you don't earn enough to make a difference. Maybe you're convinced that the whole system is rigged, so why bother? All of that is garbage thinking. It's designed to keep you in your comfort zone, where it's safe and easy to do nothing. But let me tell you something about comfort zones. They're financial quicksand. The longer you stay in one, the harder it is to get out. If you want to succeed as an investor, you have to get uncomfortable. You have to challenge every belief you've ever had about money. You have to stop seeing it as something that controls you and start seeing it as something you control. Money isn't your enemy, and it isn't your savior. It's a tool, and like any tool, its value depends on how you use it. If you use it to build, it will build. If you waste it, it will waste you. The first step to changing your mindset is to stop making excuses. I don't make enough. Wrong. You don't manage what you have. I don't know how to invest. Wrong. You've never bothered to learn. What's $10 going to do for me? Wrong. It's going to change your life if you let it. Every excuse you make is a decision to stay broke. And if you're reading this, I'm guessing you're tired of being broke. So stop making excuses and start making changes. The second step is to get real about your priorities. If you've got money for streaming subscriptions, takeout, or new clothes, you've got money to invest. The problem isn't your income, it's how you're using it. Most people spend money like they're allergic to keeping it. They let it slip through their fingers on stuff that doesn't matter, then act shocked when they're broke. Don't be most people. Be smarter than that. The third step is to start small. Stop waiting for the perfect time to start investing. It doesn't exist. The best time to start was yesterday. The second best time is today. Your first $10 investment isn't about the amount, it's about building the habit. It's about proving to yourself that you can do this. Once you start, you'll see how easy it is to keep going. And before you know it, those small amounts will add up to something big. Finally, you have to commit. Changing your money mindset isn't something you do once and forget about. It's a daily choice. Every time you decide to invest instead of spend, you're choosing to build a better future. Every time you resist the temptation to waste money, you're strengthening your discipline. And every time you remind yourself why you're doing this, you're reinforcing the habits that will lead to your success. Let me be clear. This isn't going to be easy. Changing the way you think about money is hard work. But it's the most important work you'll ever do. Because once you change your mindset, everything else becomes possible. You'll stop seeing money as something that happens to you and start seeing it as something you control. You'll stop making excuses and start making progress. And you'll realize that $10 isn't just a number, it's a statement. A statement that says, I'm ready to take control of my life. So here's your first challenge. Find $10. Not tomorrow, not next week, today. Cut out something unnecessary, skip a luxury, or sell something you don't need. I don't care how you do it, just do it. Take that $10 and commit to investing it. Because once you take that first step, there's no going back. You'll have proven to yourself that you can do this. And from there, the only limit is how far you're willing to go. Chapter 2. The case for investing on any budget. Let me stop you before you even start with the excuses. I know what you're thinking. Investing isn't for me. I barely make enough to pay the bills. Or maybe you're telling yourself, how am I supposed to invest when I don't have savings? Guess what? None of that matters. If you've got a roof over your head, food in your stomach, and even the smallest bit of cash left over each month, you're already in the game. The problem isn't that you don't have enough money. It's that you don't realize how little it takes to start investing. The system is rigged for the rich, that's true. But here's another truth. There's never been a better time for the little guy to get in the game. A couple of decades ago, investing required big money. You needed thousands just to open an account. But that world is gone. Today, you don't need brokers in suits or fat stacks of cash. You need $10. That's it. 10 measly bucks can buy you a piece of the same companies that billionaires own, but only if you're willing to see the opportunity and grab it. Here's why starting small matters. People think they need to wait until they're earning more, saving more, or just better off financially before they can invest. That's the same thinking that's kept people broke for generations. You don't wait until you're rich to invest. You invest to become rich. And no, I'm not talking about yachts and mansions. I'm talking about real wealth, having enough money to live without fear, retire without stress, and take care of the people you love. And that kind of wealth starts with what you've got right now, no matter how small it seems. The reason most people don't invest isn't that they can't afford it. It's because they don't understand how money works. They think saving is enough. Let me break it to you. Saving alone won't get you there. Inflation is eating away at your cash every single day. Every dollar sitting in your bank account is worth less tomorrow than it is today. Meanwhile, investments, real investments, are growing. If you're not putting your money to work, you're falling behind. And if you think you're safe because you've got a savings account, you're kidding yourself. Now maybe you're scared of investing. Maybe you think it's too risky. Let me ask you this. How risky is staying broke? How risky is depending on your next paycheck to survive? Because that's what you're doing right now. Every day you're not investing, you're gambling on the hope that nothing goes wrong. And hope is not a strategy. Investing isn't risky. Staying broke is. The truth is, starting small actually makes investing less risky. You're not putting your life savings on the line. You're putting a little bit of money into the market to learn how it works and to let it grow over time. If you lose a little, you adjust, you learn, you keep going. The beauty of starting with $10 is that it's manageable. It's not going to wreck your life if things don't go perfectly. And if you're consistent, that small start can turn into something big. Over time, the market rewards people who are patient and disciplined. And guess what? You don't need to be rich to be either of those things. Let's talk about what $10 can do. You might laugh at the idea of investing such a small amount. But that's because you don't understand the power of compounding. Compounding is what happens when your money starts making money. Imagine you invest $10 and it grows by just 7% a year, a reasonable average for the stock market. After a year, your $10 is worth $10.70. Not impressive, right? But here's where it gets interesting. In year 2, that 7% growth isn't just on your original $10, it's on the $10.70. Now you're at $11.45. By year 10, you've got $19.67. And by year 20, that little $10 investment has more than tripled. That's without adding another dime. If you invest $10 every month, it grows even faster. Suddenly, $10 doesn't seem so small. This isn't magic, it's math. The sooner you start, the more time your money has to grow. That's why waiting until you can't afford it is a terrible strategy. Every year you wait is a year you're losing out on potential growth. Every excuse you make is costing you money. And for what? So you can feel comfortable spending $10 on something that won't matter next week? If you've got money to waste, you've got money to invest. It's that simple. Another thing you need to understand is that investing isn't just about the money. It's about the mindset. When you decide to invest, you're making a statement. You're saying, I believe in my future. I believe I'm capable of building something better for myself. That $10 isn't just an investment in the market. It's an investment in you. It's proof that you're done making excuses and ready to take control. And once you take that first step, you'll realize how much power you have. You'll see that the system isn't as closed off as you thought. It's just waiting for you to show up. Here's the deal. You don't need a six-figure salary to invest. You don't need to know everything about the market, and you don't need a lot of money to get started. What you need is the guts to take that first step. Because once you start, you'll never look at money the same way again. You'll stop thinking of it as something you spend and start thinking of it as something you grow. And that shift is the beginning of everything. So what's stopping you? Don't tell me it's money, because we both know that's not true. Don't tell me it's fear, because staying broke is scarier. Don't tell me it's ignorance, because you've got this book in your hands. The only thing standing between you and your first investment is the decision to make it. Are you ready? Because the market doesn't care about your excuses. It only cares about action, and the time to act is now. Chapter 3. The power of compounding. If you think your $10 doesn't matter, it's because you don't understand the math. That stops now. Compounding isn't just a financial concept. It's the greatest wealth-building tool you'll ever have. It's the key to turning small investments into something that can change your life. And if you're not using it, you're leaving money on the table. Period. Let's get one thing clear. Compounding doesn't care if you're rich or broke, smart or clueless. It's a universal force, like gravity. When you put your money to work and leave it alone, it grows, and then that growth starts earning its own growth. That's compounding. Your money making money on top of money. It's how the rich get richer. But here's the kicker. It works just as well for you. The only catch is, you have to start. Every day you wait is a day you're missing out on growth. The beauty of compounding is in its simplicity. Imagine you invest $10 today and it grows by 7% this year. By the end of the year, you've got $10.70. Not exactly life-changing, right? But here's where the magic happens. Next year, that 7% growth doesn't just apply to your original $10. It applies to the $10.70. Now you're up to $11.45. It's slow at first, like watching grass grow. But over time, the numbers start to snowball. By year 20, your $10 has tripled, turning into $38.69. And if you're investing $10 every single month, by year 20, you've got over $5,000 just from letting that money sit and grow. Still not impressed? That's because you're stuck thinking in the short term. Compounding isn't about instant gratification, it's about long-term impact. The reason most people stay broke is that they can't think beyond their next paycheck. They're too focused on what feels good right now to consider what could be better 10, 20, or 30 years down the road. But here's the truth. The future is coming whether you're ready or not. Compounding is how you make sure it's a future you want to live in. Time is the secret ingredient in compounding. The longer your money has to grow, the more powerful the effect becomes. That's why starting early is so important. Every year you wait to invest, you're losing potential growth. And here's the kicker. You can't get that time back. If you're in your 20s or 30s and you're not investing, you're throwing away the one advantage you have over everyone else. Time. Even if you're older, it's never too late to start. But the earlier you begin, the bigger your gains will be. That's not speculation, it's math. Let me put it another way. Compounding is like planting a tree. At first it's small and unimpressive, but with time and patience, it grows into something massive. And the sooner you plant it, the bigger it can become. If you wait too long, you'll miss your chance. There's a reason they say the best time to plant a tree was 20 years ago and the second best time is today. The same goes for investing. If you start now, your money has decades to grow. If you wait, you're robbing yourself of that growth. Now some of you are probably thinking, what's the point? I'll never have enough money to see those kinds of gains. Wrong. The point isn't where you start, it's where you finish. Compounding doesn't care how much you're investing. It works just as hard on $10 as it does on $10,000. The only difference is your discipline and consistency. If you're willing to stick with it, your small investments can grow into something extraordinary. But if you let your doubts hold you back, you'll never see what's possible. Let's talk about discipline for a second. Compounding only works if you leave your money alone. That means no dipping into your investments every time you want something shiny. It means resisting the urge to panic when the market dips. It means staying the course, no matter how tempting it is to pull your money out. This isn't about getting rich quick. It's about getting rich for real. And real wealth takes time. You've probably heard stories about people who invested a little bit of money decades ago and ended up millionaires. Those stories aren't fairy tales. They're examples of compounding in action. Take the janitor who quietly amassed a fortune of over $8 million by investing consistently and letting his money grow. Or the secretary who retired with millions because she understood the power of time and discipline. These aren't people with high-powered jobs or massive salaries. They're people like you who started small and stuck with it. The difference between them and everyone else? They didn't make excuses. They understood that compounding is the great equalizer. But let me be clear. Compounding isn't magic. It doesn't work if you're not consistent. You can't invest $10 once and call it a day. You have to keep showing up, month after month, year after year. That's where most people fail. They get impatient, they get distracted, or they get scared. And that's how they miss out on the rewards. If you want to win with compounding, you have to commit. This isn't a one-time effort, it's a lifelong habit. Now here's your challenge. Start small, but start now. Find $10 and invest it. Then do it again next month and the month after that. Don't worry about how much you're investing, worry about how consistent you're being. Because in the long run, consistency beats everything. It beats timing the market, it beats luck, and it definitely beats doing nothing. So what's it going to be? Are you going to keep wasting your time and money, or are you going to put them to work? Compounding is waiting for you, but it's not going to wait forever. The sooner you start, the more powerful it becomes. The choice is yours. Chapter 4. Getting comfortable with risk. If you want to succeed at investing, you're going to have to get comfortable with something that terrifies most people: risk. I know, it's the word that makes everyone panic. What if I lose my money? What if the market crashes? What if I mess up? Listen carefully. Fear of risk is one of the biggest reasons people stay broke. They let their fear of losing money keep them from ever making any. That stops today. Here's the truth about risk. It's unavoidable. Whether you invest your money, save it, or hide it under your mattress, you're taking a risk. Keeping your money in cash, you're risking its value being eaten away by inflation. Putting it all in a savings account, you're risking the fact that it won't grow fast enough to beat rising costs. Even doing nothing is a risk, because it guarantees that your money won't grow at all. The question isn't whether you'll take risks, it's whether you'll take smart ones. The first thing you need to understand is that not all risks are created equal. There's a difference between calculated risks and reckless risks. A calculated risk is one you take with your eyes wide open, knowing the potential downsides, but focusing on the upside. A reckless risk is a gamble, throwing your money into something you don't understand and hoping for the best. Smart investors don't gamble. They study, they prepare, and they take calculated risks. Let me give it to you straight. Investing isn't a game of guarantees. There will be ups and downs. Some years, your investments might lose value. Other years, they might grow beyond your expectations. That's the nature of the market. The sooner you accept that, the sooner you can start focusing on what really matters, the long term. Because here's the secret: when you stay in the game long enough, the risks even out. The market has its bad days, but over time, it trends upward. That's why investing works. It's not about winning every battle. It's about staying in the fight. Think about this. Every successful investor you've ever heard of took risks. Warren Buffett took risks. The people who bought into Amazon when it was just an online bookstore took risks. The difference is, they didn't let fear stop them. They understood that risk is the price you pay for growth. You're not going to build wealth by sitting on the sidelines, waiting for a sure thing. That sure thing doesn't exist. What exists is opportunity. And opportunity always comes with risk. Now let's talk about managing risk. You don't have to dive into the deep end on day one. In fact, you shouldn't. The key to smart investing is understanding and controlling your risk. Here's how you do that. First, diversify. Don't put all your money in one stock, one fund, or one sector. Spread it out. That way, if one investment doesn't perform well, it won't wipe you out. Think of it like building a team. If one player has an off day, the others can carry the load. The same goes for your investments. Second, start small. This is why the $10 strategy works so well. You're not throwing your life savings into the market. You're starting with an amount you can afford to lose. That's not to say you want to lose it, but if things go south, it's not going to ruin you. Starting small lets you learn how the market works without taking on too much risk. Third, think long term. The stock market is unpredictable in the short term, but over decades, it has consistently gone up. When you invest for the long haul, you give your money time to recover from any temporary losses. This is why patience is one of the most valuable traits an investor can have. You don't need to react to every headline or every dip in the market. Stay focused on the big picture. Fourth, do your homework. Ignorance is one of the biggest risks you can take. Before you invest in anything, learn what you're getting into. Understand the basics of what you're buying, whether it's a stock, an ETF, or something else. The more you know, the better decisions you'll make. Here's a reality check. You will make mistakes. Everyone does. Even the best investors in the world have made bad calls. The difference between winners and losers is how they handle those mistakes. Winners learn from them, adjust their strategies, and keep going. Losers give up, blame the system, and stay broke. Which one are you going to be? The biggest mistake you can make is letting fear keep you from starting. Fear of risk is a luxury you can't afford. It's the thing keeping you on the outside, looking in. The truth is, the only way to get comfortable with risk is to face it. Take that first step. Put your $10 into the market. Watch how it moves. Learn from what happens. Over time, you'll start to see that risk isn't the monster you thought it was. It's just part of the process. Remember this, the market rewards patience and discipline. It rewards people who show up, take smart risks, and stick with it. It doesn't reward people who are too scared to start. If you want to win, you've got to play. There's no other way. So here's your challenge. Stop being afraid. Stop letting risk be an excuse. Decide today that you're going to take control of your future, no matter what. Because the truth is, the riskiest thing you can do is nothing. Every day you wait is a day you're falling further behind. Don't let fear rob you of the future you deserve. Chapter 5. Understanding your investment options. If you're serious about growing your money, you need to understand what you're putting it into. Investing isn't just throwing cash at something and hoping for the best. That's gambling. And gambling is for losers. Successful investors don't bet. They make calculated moves based on knowledge and strategy. And that starts with understanding your options. Here's the first thing you need to know. There are different types of investments, and each one works differently. Stocks, bonds, mutual funds, ETFs, real estate, it's a long list. But don't let that overwhelm you. You don't need to know everything about every investment to get started. You just need to understand the basics, pick what works for you, and keep learning as you go. Let's break this down. Stocks. When you buy a stock, you're buying a piece of a company. That's right. You become a part owner. It might be a tiny piece, but it's a piece. If the company does well, your stock increases in value. And you might even get dividends, a share of the company's profits. If the company tanks, your stock loses value. Simple as that. Stocks are powerful because they have the potential for high returns. But with that potential comes risk. The value of a stock can swing wildly based on the market, the economy, or even just the mood of investors. That's why stocks are best for long-term growth. Over time, the market trends upward, but in the short term, it can be a roller coaster. If you're not ready for that, stocks might feel scary. The key is not to panic. Remember, you're in this for the long haul. Bonds. Think of bonds as loans. When you buy a bond, you're lending your money to a government or company, and they're paying you interest in return. Bonds are less risky than stocks, but they also have lower returns. They're steady, predictable, and reliable. If stocks are the thrill seekers of the investing world, bonds are the safe, responsible ones. They're not flashy, but they get the job done. Bonds are great for stability. If you want to reduce the risk in your portfolio, adding some bonds can help. But don't get too comfortable. If you put all your money in bonds, you're not going to see much growth. Think of them as the anchor in your investment ship. They keep you steady, while the stocks do the heavy lifting. Mutual funds. Mutual funds are like investment buffets. Instead of buying individual stocks or bonds, you're pooling your money with other investors to buy a mix of investments. A professional manager decides where to invest the money, so you don't have to do the work. Sounds great, right? Not so fast. The problem with mutual funds is that they often come with high fees. Those fees eat into your returns, and over time, that can cost you big. If you're looking at mutual funds, make sure you know exactly what you're paying for. If the fees are too high, move on. There are better options. ETFs, exchange-traded funds, or ETFs, are like mutual funds, but better. They're a collection of investments you can buy and sell like a stock. The difference? ETFs usually have lower fees, which means more money in your pocket. They're also more flexible because you can trade them throughout the day, just like stocks. ETFs are perfect for beginners. They're diversified, low cost, and easy to understand. Want to invest in the whole stock market? There's an ETF for that. Want to focus on tech companies or clean energy? There are ETFs for that too. They're one of the best tools for small investors, and if you're just starting out, they should be at the top of your list. Real estate. Real estate is another way to grow your money, but let's be clear. It's not as simple as buying a house and waiting for it to go up in value. Real estate requires time, effort, and often a lot of money up front. That said, there are ways to invest in real estate without buying property. Real estate investment trusts, REITs, let you invest in real estate through the stock market. They're a great option if you want to diversify without the hassle of being a landlord. Where do you start? If you're overwhelmed, that's normal. Most beginners feel like they're drowning in choices. But here's the thing. You don't need to master every option to get started. Focus on what's simple, low cost, and effective. For most people, that means ETFs or index funds. They're diversified, easy to manage, and proven to work over time. Start there, and as you learn more, you can explore other options. Avoid the traps. Before you dive in, let's talk about what to avoid. The investing world is full of scams, schemes, and bad advice. If someone promises you guaranteed returns, run the other way. There are no guarantees in investing. Anyone who says otherwise is trying to sell you something. Watch out for high fees, too. Some investments look great on the surface, but come with fees that eat away at your returns. Always know what you're paying for, and don't be afraid to shop around for better options. Finally, don't chase trends. Just because everyone's talking about a hot stock or cryptocurrency doesn't mean it's a good investment. Stick to your plan, focus on the long term, and don't get distracted by hype. Knowledge is power. The more you learn about your options, the better decisions you'll make. But don't let the learning process paralyze you. You don't need to know everything to get started. Pick one option, start small, and build from there. Every dollar you invest is a step closer to financial freedom. So what's it going to be? Are you going to keep sitting on the sidelines, or are you going to take control? The choice is yours, and the time is now. Get out there, pick your first investment, and start building your future. Chapter 6: How to Start with $10. Here's the truth. Your first investment isn't going to make you rich. It won't pay off your debts or let you quit your job. And that's fine, because it's not supposed to. What it will do is something far more important. It will prove to you that you can start. You've spent enough time thinking about investing, talking about it, and making excuses for why you haven't done it yet. Today, that stops. The beauty of starting with $10 is that it strips away the barriers you think are holding you back. You don't need to wait until you're earning more money. You don't need to save for months to have a respectable amount to invest. You don't need to know everything about the stock market. All you need is the willingness to put one foot in front of the other and take the first step. Opening an investment account isn't some monumental task reserved for financial gurus. It's a simple process that anyone with a smartphone can complete in minutes. There are countless platforms and apps designed for people just like you. People who don't have thousands to invest, but still want to build something meaningful over time. Find one that lets you start small and charges minimal fees. Don't get caught up in trying to pick the perfect platform. What matters is that you get started. Once you've got your account, the next move is simple. Put your $10 to work. Stop overthinking it. You don't need to analyze hundreds of companies or time the market like some Wall Street wizard. Start with something simple and reliable. An index fund or ETF that tracks the stock market is a solid choice. These funds are already diversified, meaning your $10 is spread across many companies. That reduces your risk and gives you a strong foundation. You don't need to reinvent the wheel here. Just pick something proven and get going. When you buy your first investment, you're going to feel a mix of emotions. Maybe you'll be excited. Maybe you'll be nervous. Maybe you'll feel like $10 is too small to matter. Ignore that last thought. It does matter, because it's not about the size of the investment. It's about what it represents. That $10 is the beginning of a habit, the start of a journey, and the first step toward taking control of your financial future. Now, let's talk about what comes next. Your first $10 isn't a one-and-done deal. If you're serious about building wealth, you need to make investing a habit. This is where most people fail. They invest once, feel good about themselves for a week, and then go right back to their old habits. That's not going to be you. You're going to keep showing up month after month, no matter what. It doesn't matter if it's $10, $20, or $100. What matters is consistency. Because consistency beats everything else. It beats luck, timing, and even the size of your investments. Over time, small, regular contributions add up in ways you can't imagine right now. Here's the other thing you need to understand. You're going to make mistakes. Everyone does. Maybe you'll pick the wrong investment. Maybe the market will take a dip and you'll see your $10 turn into $9.50. That's normal. What separates successful investors from everyone else is how they handle those mistakes. Successful investors learn, adjust, and keep going. They don't let fear or frustration push them out of the game, and neither will you. It's also important to set your expectations straight. Investing isn't about getting rich overnight. If that's what you're after, go buy a lottery ticket and leave the real work to people who understand how wealth is built. Investing is about the long game. It's about putting your money to work so that it grows steadily over time. Some years will be better than others. The market will go up and it will go down. But if you stick with it, you'll see that the overall trend is upward. That's how the system works, for those who stay in it. By now, you might still be thinking, this is all so small. What difference does $10 really make? Let me tell you something. The only reason it feels small is because you're stuck thinking about today. Start thinking about tomorrow. That $10 is going to grow. It's going to earn money, and that money is going to earn more money. Over time, the little contributions you make now will snowball into something much bigger, and you'll look back and wonder why you ever doubted it. So here's the challenge. Stop waiting. Stop overthinking. Stop letting fear and excuses hold you back. Take $10, today, not tomorrow, and put it into the market. You don't need a perfect plan, you just need to start. Because once you do, everything else gets easier. The hardest part of any journey is the first step. Take it now. Chapter 7. Building your first portfolio. Congratulations, you've taken the first step. You've made your initial investment, and now you're officially in the game. But let's get one thing straight. Buying a single stock, ETF, or fund doesn't make you an investor. Building a portfolio does. A portfolio isn't just a collection of investments. It's your strategy for long-term growth. It's your plan for turning small, consistent contributions into real wealth. And if you're serious about this, it's time to learn how to do it right. Here's the hard truth. Most people don't think about their investments as a portfolio. They throw their money at random stocks or funds hoping something will stick. That's not investing. That's guessing. If you want to succeed, you need a portfolio that's intentional, balanced, and built to last. You're not here to gamble, you're here to grow. So what makes a portfolio work? Balance. Every piece of your portfolio plays a role, and the goal is to make sure those pieces work together. Some investments will provide growth, others will provide stability, and together they'll create something stronger than the sum of its parts. Building a portfolio is like building a team. You don't need all superstars. You need players that complement each other and get the job done. For beginners, the simplest and most effective portfolios are built around diversification. Diversification means spreading your money across different types of investments so that no single loss can wreck your progress. It's your first line of defense against risk, and it's one of the most important principles in investing. Imagine putting all your money into one company, only to watch it fail. That's a disaster. Now imagine spreading your money across hundreds of companies. If one fails, it barely makes a dent. That's diversification at work. The easiest way to diversify is through index funds or ETFs. These investments automatically spread your money across a wide range of companies, sectors, or even entire markets. For example, an S&P 500 index fund gives you exposure to 500 of the biggest companies in the US, while a total market fund gives you access to thousands. With one investment, you're instantly diversified. It's simple, efficient, and perfect for beginners. Now, let's talk about allocation. Allocation is how you divide your money among different types of investments, such as stocks, bonds, and cash. The right allocation depends on your goals, your timeline, and your tolerance for risk. If you're young and investing for the long term, you can afford to take more risks. That means leaning heavily towards stocks, which have the highest potential for growth. If you're older or more risk-averse, you might want a more balanced approach with a mix of stocks and bonds. For most beginners, a portfolio made up of 80% stocks and 20% bonds is a solid starting point. It gives you the growth potential of stocks with the stability of bonds. As you learn more and your situation changes, you can adjust your allocation to fit your needs. The key is to start with something simple and build from there. One mistake many new investors make is thinking they need to invest in everything right away. They spread themselves too thin, chasing every opportunity they see. That's not diversification. That's chaos. A strong portfolio isn't about having as many investments as possible. It's about having the right ones. Focus on a few high-quality options that align with your goals and ignore the rest. You don't need to own every stock or fund to succeed. You just need to own the right ones. As you build your portfolio, remember that it's a living thing. It's not something you set up once and forget about. Markets change, your goals change, and your portfolio needs to change with them. That doesn't mean you should constantly tinker with it. Overreacting to every market move is a recipe for disaster, but you should review it regularly, making adjustments as needed to keep it on track. Think of it as routine maintenance. You wouldn't ignore your car for years and expect it to run perfectly. Your portfolio is no different. Here's the part where discipline comes in. Building a portfolio isn't a one-time event. It's an ongoing process that requires consistency and patience. You're not going to see massive results overnight, and that's okay. Investing is a marathon, not a sprint. The goal is to keep showing up, month after month, year after year, until your portfolio grows into something significant. That's how wealth is built, not with big, flashy moves, but with steady, disciplined effort. The good news is that you don't have to do this alone. Many investment platforms offer tools to help you build and manage your portfolio. Some even create portfolios for you based on your goals and risk tolerance. If you're not sure where to start, take advantage of these resources. They're there to make the process easier, so use them. At this point, you might be thinking, this all sounds great, but I don't have enough money to build a real portfolio. Stop right there. That kind of thinking is what keeps people broke. You don't need thousands of dollars to start. You need $10. Every great portfolio started small. The difference between the people who succeed and the people who don't is that the successful ones started. Your portfolio might not look like much right now, but that's not the point. The point is that you're building something, and over time, it will grow. So what's stopping you? You've got everything you need to start building your portfolio today. Don't wait until you think you're ready. The truth is, you're ready now. Take your $10, pick your investments, and start building. Because the longer you wait, the longer it will take to see the results you want. Your portfolio won't build itself. It's up to you to make it happen. Chapter 8. Staying the course during market ups and downs. Let me be blunt. The stock market is not your friend. It doesn't care about your feelings, your plans, or your fears. It's going to rise, fall, and sometimes crash, and there's nothing you can do to stop it. But here's the good news. You don't have to. Your job isn't to control the market, it's to control yourself. If you can do that, you'll succeed where most people fail. Here's the reality. Markets go up and markets go down. That's how they work. The mistake most people make is thinking that every dip or crash is the end of the world. They panic, sell everything, and lock in their losses. Then, when the market inevitably recovers, they're stuck on the sidelines, regretting their decision. Don't be that person. If you want to build wealth, you need to learn how to stay the course, no matter what the market is doing. The first step is understanding that volatility is normal. The market doesn't move in a straight line, it zigzags. There are good days, bad days, and sometimes terrible days. But over time, the overall trend is upward. That's not a guess, that's history. Look at any long-term chart of the stock market, and you'll see it clearly. Yes, there are crashes and corrections along the way, but the market always recovers. The key is staying invested long enough to see that recovery. You might be wondering, what if the market crashes right after I invest? That's a fair question, and here's the answer. It doesn't matter. If you're investing for the long term, what happens in the next week, month, or even year isn't important. What matters is what happens over decades. The only people who lose money in a crash are the ones who sell. If you hold on, your investments will have time to recover and grow. Patience is your greatest weapon as an investor. Use it. Now, let's talk about emotions. When the market takes a nosedive, your instinct will be to panic. You'll want to pull your money out and wait for things to settle down. Don't do it. Acting on emotion is one of the fastest ways to derail your financial future. Successful investors don't react to every market move. They stick to their plan, even when it's uncomfortable. That's what separates them from the masses. One way to keep your emotions in check is to focus on the big picture. Remind yourself why you're investing in the first place. You're not in this for quick wins. You're in it to build wealth over time. Short-term losses are just bumps in the road. They're part of the journey, not the destination. If you can stay focused on your goals, those bumps won't seem so scary. Another strategy is to avoid checking your investments too often. The more you look at the market, the more tempted you'll be to react to its every move. Remember, you're playing the long game. You don't need to know what your portfolio is doing every hour of every day. Set a schedule for checking in, once a month, once a quarter, whatever works for you, and stick to it. This will help you stay calm and avoid making impulsive decisions. Diversification also plays a big role in helping you stay the course. When your portfolio is spread across different types of investments, a drop in one area won't hurt as much. For example, if stocks take a hit but you've got some money in bonds, your overall portfolio will be more stable. This balance makes it easier to weather the ups and downs without losing sleep. Here's something most people don't realize. Market downturns are actually opportunities. When prices drop, you can buy quality investments at a discount. Think of it like a sale at your favorite store. Instead of panicking, see it as a chance to add to your portfolio at a lower cost. This is how disciplined investors turn market crashes into long-term gains. Let me give you an example. Imagine you're investing $10 every month into an index fund. When the market is up, your $10 buys fewer shares because prices are higher. But when the market is down, your $10 buys more shares because prices are lower. Over time, this strategy, called dollar cost averaging, helps smooth out the impact of market fluctuations. The key is staying consistent, no matter what the market is doing. But let's be real. Staying calm during a crash is easier said than done. That's why it's so important to have a plan. Before you even start investing, decide how you'll handle market downturns. Write it down. When the market drops, will you hold steady, buy more, or adjust your allocation? Having a plan in place will help you stay rational when emotions start to take over. Here's the bottom line. The market doesn't reward panic. It rewards patience, discipline, and consistency. If you can stay invested during the tough times, you'll be in a position to benefit when things turn around. And they always do. The people who succeed in the market aren't the ones who avoid risk. They're the ones who embrace it and stay the course. So the next time the market drops, don't panic. Don't second-guess yourself. Don't let fear dictate your decisions. Remember, you're not here to win every battle. You're here to win the war. And the only way to do that is to keep going, no matter what. The market will test you. It will try to shake your confidence and push you out. Your job is to hold the line. Stay the course, stick to your plan, and trust the process. That's how you win. Chapter 9. Turning investing into a habit. Let me give it to you straight. If you think you can dabble in investing and get somewhere, you're wasting your time. Investing isn't a hobby. It's not something you do when it's convenient or when you're in the mood. It's a habit, a discipline that you build into your life and stick with, no matter what. If you can't commit to that, close the book now. This isn't for quitters. You know what separates people who build wealth from those who stay broke? It's not intelligence, luck, or even income. It's consistency. The people who succeed are the ones who keep showing up, month after month, year after year, no matter how small their contributions are. They don't make excuses, and they don't skip months because things are tight right now. They understand that wealth isn't built in a day. It's built brick by brick, one small investment at a time. If you're not already doing this, it's time to stop pretending and get serious. Your first $10 investment was great. It got you in the game. But it's not enough. If you don't keep going, that $10 is just a fluke, a nice little story you'll tell about that one time you invested. And that's worthless. What matters is what you do next. Are you going to keep showing up? Or are you going to quit the moment it gets inconvenient? Here's the deal. Habits run your life, whether you realize it or not. Every dollar you spend, save, or waste is a product of the habits you've built over time. If you're always broke, it's because you've built broke habits. You're spending without thinking, putting off saving, and convincing yourself that you'll start later. That stops now. From this moment forward, your money habits are going to change. And that starts with turning investing into a non-negotiable part of your routine. Think about it. Do you hesitate to pay your rent or mortgage each month? Do you skip your utility bill because you don't feel like paying it? Of course not. You make those payments because they're non-negotiable. You don't have a choice. Investing needs to work the same way. It's not optional. It's not something you do when it's convenient. It's a commitment you make to yourself, no matter what. The easiest way to make investing a habit is to automate it. If you're relying on willpower to remember to invest each month, you're setting yourself up to fail. Willpower is unreliable, and life will always find a way to get in the way. But automation takes willpower out of the equation. Set up recurring deposits into your investment account. $10, $20, $50, whatever you can afford, and let the system do the work for you. You'll be investing consistently without even thinking about it. But what if something comes up? You might ask. Guess what? Something will always come up. There's always going to be a bill, an emergency, or some other excuse to put off investing. That's life. The question is whether you're going to let those excuses control you. If you treat investing as negotiable, you'll never build wealth. It has to be untouchable, like rent or groceries. No matter what's happening in your life, you invest. Period. Let's talk about mindset. Most people treat investing like it's optional because they don't value their future. They value their present comforts more than their long-term security. They'd rather spend $10 on fast food today than invest it for tomorrow. That's not just a money problem. It's a priorities problem. If you want to succeed, you need to flip your mindset. Your future matters more than your momentary pleasures. Investing is how you prove that to yourself. Here's another thing. Habits don't just form, they're built through repetition. The more you invest, the more natural it becomes. It stops feeling like a chore and starts feeling like second nature. You don't think twice about brushing your teeth every morning. It's just what you do. Investing should feel the same way. It's not an event, it's a routine. And routines are what separate people who achieve their goals from people who just talk about them. But let me be clear, building this habit is going to require discipline. There will be times when you don't feel like investing. Maybe money's tight, or maybe you're tempted to spend it on something else. That's when you need to double down. Remind yourself why you're doing this. You're not just investing for the sake of it. You're building a future that's bigger than the excuses you're making right now. The only way to get there is to stay consistent. And let's not forget accountability. Most people fail to build habits because there's no one holding them accountable. They skip a month, shrug it off, and promise to make it up later. That's how habits die. If you're serious about this, find a way to keep yourself accountable. Tell a friend or family member about your investing goals. Track your progress in a journal or app. Do whatever it takes to make sure you're staying on track. And if you slip up, own it. Fix it, get back on the horse, and keep going. The truth is, there are no shortcuts here. You can read all the books, watch all the videos, and take all the courses you want, but none of it matters if you don't put it into action. Building wealth isn't about knowing, it's about doing. And doing consistently. You can't just invest once and expect to see results. You have to keep showing up, no matter how small the contributions are. So here's the challenge. Commit to making investing a habit. Decide right now that you're going to invest every single month, no matter what. Automate it, prioritize it, and hold yourself accountable. Because if you don't, you're wasting your time. This isn't about dabbling. This is about changing your life. And the only way to do that is to show up consistently, over and over again, until the results start speaking for themselves. No more excuses, no more skipping months, no more, I'll start later. Your future starts today, and it's waiting for you to step up. Are you ready? Then act like it. Make the commitment, build the habit, and don't look back. That's how you win. Chapter 10. Scaling up as you grow. You've started small, and you've built the habit. That's great, but now it's time to level up. If you're serious about building wealth, you can't stay in the $10 a month club forever. At some point, you need to scale up. And that's where most people get stuck. They get comfortable, complacent, and start telling themselves that small contributions are good enough. Let me be clear. They're not. Yes, starting small is important. It's how you build the discipline and confidence to invest. But scaling up is what separates the dabblers from the serious wealth builders. If you stay stuck at the beginner level forever, you'll end up with beginner results. That's fine if all you want is a little extra money in retirement. But if you want real freedom, the kind that lets you live life on your terms, you need to push yourself. You need to grow your contributions as your income grows, and you need to start doing it now. Let's get one thing straight. Scaling up doesn't mean throwing caution to the wind. It's not about dumping every spare dollar into the market and hoping for the best. It's about being intentional, strategic, and disciplined with how you grow your investments. You've already proven you can stick to a routine. Now it's time to build on that foundation and take things to the next level. The first step is looking at your budget. And don't tell me you don't have one. If you're investing without a budget, you're flying blind, and that's a recipe for disaster. A budget isn't a restriction, it's a tool. It shows you exactly where your money is going and where you can make adjustments. If you want to scale up your investing, you need to find the money to do it. That means cutting out unnecessary expenses, increasing your income, or both. But I already cut back. You might say. Great, now cut back more. Look at your spending and ask yourself one question. Does this expense matter more than my financial future? If the answer is no, it's time to let it go. Cancel the subscriptions you barely use. Stop eating out every week. Shop smarter. Every dollar you free up is a dollar you can put toward building wealth. And if you think you can't cut anything else, you're lying to yourself. There's always something you can cut if you're willing to make the sacrifice. Of course, cutting expenses is only part of the equation. At some point, you're going to hit a wall. You can only cut so much before there's nothing left to trim. That's when you need to start thinking about increasing your income. Maybe that means taking on a side hustle, picking up extra hours at work, or finding a better paying job. Whatever it takes, do it. Scaling up isn't about staying in your comfort zone. It's about pushing yourself to grow, both financially and personally. Once you've freed up more money, the next step is deciding how to allocate it. This is where things get exciting. When you were just starting out, you might have been limited to a single investment, a basic ETF or index fund. But as you scale up, you can start diversifying and exploring new opportunities. Maybe you add a sector-specific ETF to your portfolio, invest in individual stocks, or dip your toes into real estate through REITs. The key is to stay focused on your goals and keep your portfolio balanced. But let's be real, scaling up isn't just about the mechanics of investing. It's about mindset. As your contributions grow, so will your fear of losing money. Suddenly the stakes feel higher. You might hesitate, overthink, or second-guess yourself. Don't. The principles you learned when you were investing $10 a month still apply when you're investing $100, $500, or more. The market doesn't care how much you're investing. It rewards consistency, discipline, and patience. Stick to your plan and trust the process. One of the biggest traps people fall into when scaling up is lifestyle inflation. They start earning more, but instead of investing the extra income, they spend it. A bigger paycheck becomes an excuse for bigger expenses. A nicer car, a bigger house, more vacations. Before they know it, they're back to living paycheck to paycheck, even though they're earning more than ever. Don't let that be you. Every time your income increases, ask yourself how much of that increase you can invest. The more you invest now, the more freedom you'll have later. Here's another thing to keep in mind. Scaling up doesn't mean going all in on high-risk investments. It's tempting to chase big returns when you're contributing more money, but that's how people lose everything. Stick to the fundamentals. Diversify, balance risk and reward, and focus on the long term. Your goal isn't to get rich quick, it's to build sustainable wealth over time. Scaling up is about adding fuel to the fire, not burning it out. As you grow your portfolio, remember that this isn't a one-size-fits-all journey. How much you scale up and how quickly depends on your unique circumstances. Maybe you can double your contributions next month. Maybe it'll take you a year to get there. That's fine. The important thing is that you're moving forward. Progress is progress, no matter how small. So here's your challenge. Stop settling. Stop telling yourself that $10 a month is good enough. It's a start, but it's not the finish line. Look at your finances, find the money to scale up, and make it happen. Push yourself to grow, even when it's uncomfortable. Because the truth is, comfort doesn't lead to wealth. Action does. You've built the habit. Now it's time to take it further. This is where the real growth happens. Not just in your portfolio, but in you. The question is, are you ready to level up? Or are you going to stay stuck where you are, pretending that small steps are enough? The choice is yours. Make the right one. Chapter 11. Avoiding Pitfalls and Common Mistakes. Let's get one thing straight. The fastest way to ruin your progress as an investor is by making dumb mistakes. You can spend months or even years building your portfolio, only to watch it all go up in smoke because you weren't paying attention or didn't have the discipline to avoid obvious traps. Investing is simple, but it's not easy. The market doesn't care about your intentions. It rewards smart decisions and punishes sloppy ones. Your job is to stay sharp, stay focused, and stay out of your own way. The first and most common mistake new investors make is chasing the hype. You've seen it before. Everyone's talking about the latest hot stock or cryptocurrency, and suddenly it feels like you're missing out if you're not jumping in. Here's the truth. By the time you hear about a sure thing, it's probably already too late. The market moves fast, and the crowd is usually wrong. The people who make money from hype aren't the ones buying late. They're the ones who got in early and are now cashing out on your fear of missing out. Don't play that game. Stick to your plan and let everyone else chase the next bubble. Another mistake is overreacting to market news. If you're constantly glued to financial headlines, reacting to every dip and surge, you're setting yourself up for failure. The market is volatile. It always has been, and it always will be. That's not a reason to panic. Selling out of fear when the market drops is the easiest way to lock in losses. Remember, you don't lose money when the market dips. You lose money when you sell. Stay calm, stay invested, and trust the process. Speaking of staying invested, let's talk about timing the market. A lot of people think they can outsmart everyone else by buying at the bottom and selling at the top. Spoiler alert, they can't. Even professional investors with years of experience and access to the best tools in the world can't consistently time the market. What makes you think you can? The truth is, trying to time the market is a fool's game. You're better off staying consistent, investing regularly, and letting time do the heavy lifting. Another pitfall you need to avoid is ignoring fees. They might not seem like a big deal at first. What's a 1% fee, right? Wrong. Over time, those fees add up and eat into your returns. If you're not paying attention, you could be giving away thousands of dollars for no good reason. Before you invest in anything, understand what you're paying and why. If the fees are too high, find a better option. The less you pay in fees, the more money stays in your pocket, where it belongs. Let's not forget about diversification, or the lack of it. Putting all your money into one stock, fund, or sector is a rookie mistake. It's tempting to go all in on something you're confident about, but what happens if you're wrong? Diversification isn't just a buzzword, it's your safety net. Spread your money across different investments, so no single loss can wipe you out. It might not be as exciting as betting it all on one big winner, but it's a lot smarter. Another trap to avoid is checking your portfolio too often. Look, I get it. You're excited about your investments and you want to see how they're doing. But constantly checking your portfolio is a recipe for stress and bad decisions. The more you look, the more tempted you'll be to react to every little movement in the market. That's not investing, that's micromanaging. Set a schedule for reviewing your portfolio and stick to it. Once a month or once a quarter is plenty. Now, let's talk about emotions. Fear and greed are your worst enemies as an investor. Fear makes you sell when you should be holding, and greed makes you take risks you shouldn't. Both will wreck your portfolio if you let them. The key is to stick to your plan no matter what your emotions are telling you. Investing is a rational game, not an emotional one. If you can't control your emotions, you're not going to last. One of the sneakiest pitfalls is lifestyle inflation. As you start making more money, it's tempting to upgrade your life. Bigger house, nicer car, more vacations. And while there's nothing wrong with enjoying the fruits of your labor, you need to make sure it's not coming at the expense of your financial goals. Every dollar you spend on luxuries is a dollar that could be working for you in the market. Keep your lifestyle in check and put your extra income to work. Finally, don't lose sight of your long-term goals. It's easy to get distracted by short-term results, especially when the market is doing well. But remember, you're not investing for today or tomorrow. You're investing for the next 10, 20, or 30 years. Keep your focus on the big picture, and don't let short-term noise throw you off track. Here's the bottom line. Mistakes are going to happen. Nobody gets it right all the time, not even the pros. The difference between successful investors and everyone else is how they handle those mistakes. Successful investors learn from them, adjust their strategy, and keep moving forward. They don't let one setback derail their progress, and neither should you. So, here's your challenge. Commit to avoiding the pitfalls that trip up most investors. Don't chase the hype. Don't panic when the market dips. Don't waste money on high fees or get lazy with diversification. And above all, don't let your emotions or your lifestyle get in the way of your goals. If you can do that, you'll be ahead of most people before you even get started. No excuses, no shortcuts. Just smart decisions and consistent action. That's how you win. Now go out there and make it happen. Chapter 12. Planning for Financial Freedom. Let's cut to the chase. If you don't have a plan, you're not going to get anywhere. Financial freedom doesn't happen by accident, and it's not going to fall into your lap because you've made a few investments. It's earned. One smart decision at a time, one disciplined habit at a time, one clear goal at a time. If you're just winging it, hoping your investments will magically grow into something meaningful, you're fooling yourself. It's time to get serious and start planning. First, let's define what financial freedom actually means. For some people, it's about retiring early. For others, it's about having the flexibility to leave a job they hate or take care of their family without stressing about money. Whatever it means to you, it comes down to one thing: choice. Financial freedom is the ability to make decisions based on what you want, not what you can afford. It's about living life on your terms. And if that's what you want, you need to be intentional about getting there. Step 1 is getting crystal clear about your goals. What does financial freedom look like for you? Don't be vague. Saying, "I want to be rich," isn't a goal. It's a fantasy. A goal is specific, measurable, and tied to a timeline. For example, I want to have $500,000 invested by the time I'm 50 so I can retire early and travel full-time. That's a goal. It gives you something concrete to aim for, and it's the foundation of your plan. Once you've set your goals, it's time to figure out the numbers. How much money will you need to achieve them? This might take a little research and some basic math, but don't let that scare you. Look at your current expenses, factor in inflation, and think about what your life will look like when you're financially free. Will your costs go up or down? Will you still be working part-time, or will you be fully retired? The more detailed you can get, the better. Now that you know your target, it's time to reverse engineer it. If you need $500,000 by the time you're 50, how much do you need to invest each month to get there? Use a compound interest calculator to figure it out. Plug in your expected rate of return, your timeline, and your starting amount. The result will show you exactly what you need to do. And if the number looks intimidating, don't panic. Remember, you can start small and scale up as your income grows. The important thing is to have a plan and stick to it. But having a plan isn't enough. You need to protect it. Life is going to throw curveballs at you: unexpected expenses, emergencies, and market downturns. If you're not prepared, those curveballs will knock you off track. That's why building an emergency fund is non-negotiable. Before you start scaling up your investments, make sure you've got at least 3 to 6 months of living expenses saved in cash. This isn't money you invest, it's money you keep on hand for emergencies. Think of it as your safety net. Without it, one bad break could derail your entire plan. Another way to protect your plan is by managing your risk. Diversification, which we've already talked about, is a big part of this, but so is understanding your own tolerance for risk. If you're losing sleep over your investments, you're probably taking on too much risk. On the flip side, if you're playing it too safe, you're not going to see the growth you need. Finding the right balance is crucial, and it might take some trial and error. The key is to stay focused on your long-term goals and adjust as needed. Now let's talk about accountability. A plan is useless if you're not holding yourself accountable to it. Track your progress. Review your investments regularly to make sure you're on track. And don't be afraid to adjust your plan if your circumstances or goals change. Life happens, and your plan needs to evolve with it. But make no mistake, adjusting your plan is not the same as abandoning it. Stay disciplined, stay focused, and keep moving forward. One of the most important aspects of planning for financial freedom is setting milestones. Long-term goals can feel overwhelming, so break them down into smaller, manageable steps. Celebrate each milestone as you hit it. Did you save your first $1,000? Celebrate. Did you hit $10,000 in your investment account? Celebrate. These milestones aren't just numbers, they're proof that your plan is working. They're fuel to keep you going. And don't forget to think about the bigger picture. Financial freedom isn't just about having money, it's about what that money allows you to do. Maybe it's traveling the world, starting a business, or giving back to your community. Whatever it is, keep it front and center in your mind. Your plan isn't just about numbers, it's about creating the life you want. Here's the hard truth. Financial freedom requires sacrifice. It means saying no to things you want now so you can have the life you want later. It means sticking to your plan, even when it's hard, boring, or inconvenient. But the payoff is worth it. The freedom to live life on your terms is priceless, and it's something most people will never achieve, because they're too busy chasing short-term comfort. Don't be like them. Be better. So here's your challenge. Sit down and create your plan for financial freedom. Define your goals, figure out your numbers, and commit to the sacrifices you need to make to get there. Write it down, review it regularly, and hold yourself accountable. Because the truth is, financial freedom isn't just going to happen. You have to make it happen. And if you're willing to do the work, there's nothing stopping you. Chapter 13, The Broader Impact of Small Investments. It's easy to get caught up in your own goals. Retirement, financial freedom, building wealth for yourself. And that's fine. Those goals matter. But let me ask you something. Have you thought about the bigger picture? Have you considered what your investments could mean for the people around you, for your family, for your community? Because here's the truth. What you're building isn't just for you. It has the potential to ripple out and change the lives of others in ways you haven't even imagined. Small investments may seem insignificant when you're starting out. You might look at your $10 a month and think, what's the point? This won't make a difference. But you'd be wrong. Every dollar you invest has the power to grow. And that growth can compound, not just in your portfolio, but in your life and in the lives of those you touch. The decisions you make today will echo into the future, shaping not just your financial reality, but the opportunities you can create for others. Think about your family. Maybe you're building wealth to ensure a comfortable retirement for yourself. But what happens when you go beyond that? What happens when your investments allow you to pay for your child's education, help a family member in need, or leave an inheritance that sets the next generation up for success? You're not just building wealth, you're breaking cycles. You're creating opportunities that might have felt impossible when you were growing up. For many people, investing is about more than personal gain. It's about rewriting the story of financial insecurity that's been passed down through generations. Maybe you grew up in a household where money was always tight, where debt was a constant stressor, and where investing seemed like something only rich people could do. By taking control of your finances and building wealth, you're proving that it doesn't have to be that way. You're showing your family, your kids, your siblings, your parents, that there's a different path. And that kind of leadership has a lasting impact. But it doesn't stop with family. When you build wealth, you gain the power to give back to your community. Imagine being able to support local businesses, fund scholarships, or donate to causes you care about. Imagine what your investments could do for the people around you, not just today, but years from now. Wealth isn't just about living a comfortable life, it's about creating a legacy. And the most meaningful legacies are the ones that lift others up. Let's talk about financial education for a moment. The lessons you learn as an investor aren't just for you. They're lessons you can pass on to others. Maybe it's teaching your kids how to manage money wisely, showing a friend how to start investing, or mentoring someone who feels as lost as you did when you first started. Knowledge is one of the most valuable things you can share, and the more you learn, the more you can help others avoid the mistakes you've made. You might not think of yourself as a role model, but that's exactly what you become when you start investing. People notice. They see the choices you're making, the discipline you're building, and the progress you're achieving. And whether they tell you or not, you're inspiring them. Maybe it's a coworker who decides to open their first investment account after hearing you talk about yours. Maybe it's a sibling who starts budgeting after seeing how you've turned your finances around. Your actions have the power to influence others in ways you'll never fully realize. There's also the potential for broader societal impact. When more people invest, it creates a stronger, more inclusive economy. It challenges the idea that wealth building is only for the elite. It shows that financial freedom is achievable for anyone willing to put in the work. By investing, you're not just changing your own circumstances, you're part of a movement that shifts the narrative around money and opportunity. But let's not sugarcoat this. Building wealth takes time, effort, and sacrifice. You're going to face challenges, and then there will be moments when it feels like the progress is too slow to matter. Those are the moments when you need to remember why you're doing this. It's not just for you. It's for the people who are depending on you, the people who will benefit from your efforts, and the example you're setting for others. Every dollar you invest, every choice you make, is part of something bigger than yourself. Now let me be clear. This isn't about charity. It's not about giving away everything you've worked so hard to build. It's about understanding the power and responsibility that come with wealth. When you have the resources to help others, you're in a position to create change. And when you do that, you're not just building a portfolio, you're building a legacy. Here's the challenge. Start thinking beyond yourself. Yes, focus on your goals and your financial freedom, but don't stop there. Ask yourself how your investments can create opportunities for others. Ask yourself what kind of example you want to set for your family, your friends, and your community. Because at the end of the day, the impact of your wealth isn't measured by the number in your bank account. It's measured by the lives you touch. You're building something powerful, whether you realize it or not. The question is, how far are you willing to take it? Are you content with financial freedom just for yourself? Or are you ready to create a ripple effect that extends beyond your own life? The choice is yours. And if you're ready to step up, the time to start is now. Chapter 14. Writing Your Own $10 Success Story. Here's the truth. You've been reading about what's possible. You've been learning about discipline, consistency, and the power of small investments. But now it's time to stop reading and start writing. Your story, your journey, your legacy. Because none of this matters if you don't act. Knowledge without action is just wasted potential. Your $10 isn't just money, it's a decision. It's the moment you choose to take control of your financial future. It's the seed of something greater, but only if you're willing to plant it and nurture it. Think about it. What story do you want to tell 10, 20, or 30 years from now? Do you want to look back and say, I wish I had started? Or do you want to say, that $10 changed everything? The thing is, success stories don't start big. They start small, almost insignificantly. That janitor who quietly retired a millionaire didn't get there overnight. Neither did the secretary who left behind a fortune. They didn't win the lottery, inherit millions, or stumble upon some secret formula. They started with what they had, stuck to the plan, and let time do the rest. Their stories are proof that small, consistent actions lead to extraordinary results. And your story can be no different, if you're willing to make the commitment. But let's be clear, a success story isn't just about the ending. It's about the journey. It's about the discipline you build, the lessons you learn, and the challenges you overcome. Those moments when you want to give up but don't. When the market dips and you stay the course. When life gets hard but you keep investing anyway. That's where the real story is written. It's in the process, not just the result. Every success story has a turning point. This is yours. This is the moment when you decide whether you're going to keep making excuses or start making progress. Are you going to wait for the right time, the perfect opportunity, the magic formula? Or are you going to take the first step today, no matter how small, and let it be the foundation of something greater? Because let me tell you something. Waiting gets you nowhere. Action is the only thing that moves you forward. You don't have to be perfect to start. You don't need to know everything or have it all figured out. You just need to take the first step, then the next, and the next. The beauty of investing is that it rewards consistency, not perfection. You don't have to get every decision right. You just have to keep showing up. That's how stories are written, one small step at a time. Now, let's talk about the excuses that are still lingering in your mind. I don't have enough money. I don't know where to start. What if I fail? Let me tell you something. Those excuses are the only things standing between you and your success story. They're not real barriers. They're the stories you've been telling yourself to stay comfortable. But comfort doesn't lead to growth. It doesn't lead to freedom. And it definitely doesn't lead to success. If you want to write a different story, you need to get uncomfortable. You need to stop letting fear and doubt control your decisions. Here's the thing. Nobody else is going to write this story for you. Your friends won't do it. Your boss won't do it. The government definitely won't do it. This is on you. It's your responsibility, and it always has been. But that's not a burden. It's an opportunity. Because if you have the power to make the choices that create your story, you also have the power to make it a great one. Imagine yourself years from now, looking back on this moment. What would the future you say about the choices you're making today? Would they thank you for starting, for staying consistent, for sticking to the plan, even when it was hard? Or would they wish you had done more, started sooner, pushed harder? The story you'll tell in the future depends on the decisions you make now. Success Doesn't have to look like $1 million portfolio or early retirement. Your story is yours to define. Maybe success for you is breaking the cycle of financial insecurity in your family. Maybe it's creating a safety net that gives you peace of mind. Maybe it's teaching your kids the value of investing so they can start their own stories even earlier than you did. Whatever it looks like, own it, define it, and work for it. This isn't just about money. It's about proving to yourself that you can do hard things, make smart decisions, and stick to your commitments. It's about building a life that reflects your values, goals, and priorities. Your investments are a tool, not an end in themselves. Use them to build the life you want, the life you deserve. So here's your challenge. Start writing your success story today. Take $10 and invest it. Then do it again next month and the month after that. Build the habit, grow your discipline, and stay the course. And don't stop when it gets hard, boring, or inconvenient. That's when the best stories are written, in the moments when most people quit, but you keep going. One day, you'll look back and realize that the story you've written is bigger than you ever imagined. It's not just about the money. It's about the discipline, the growth, the impact you've created. It's about the lives you've touched, the example you've set, and the legacy you've built. That's what makes a success story truly great. No more waiting, no more excuses. Your story starts now. Write it well. You have been listening to the $10 Investor Growing Wealth on a Shoestring Budget.